Hey, what's up, everybody? Welcome back to another episode of the Liquid Lunch Project. I am Matthew R. Meehan, alongside my partner, the Professor Luigi Rosabianca. What's on tap today, Lou?
Matt, today we've got a special guest live from Chicago. We've got Tom Dillon, who is the principal and founder of Frac Finance. It's a play on words. He's a fractional CFO, but he brings a really special skill set because he's dealing with small and medium-sized business owners that are acquiring businesses and are experiencing hyperbolic growth. So let's welcome Tom to the podcast. Mr. Dillon, thank you for joining us.
Matt, pleasure to be here, and thank you for that introduction. That saves me explanation.
How are things in the Windy City?
Windy City's good. We're hitting our first 80-degree day today, and so everyone's going to be going nuts out on the patios, having a couple cold ones.
Okay, so let's talk about the small and medium-sized business space because, man, there's a lot of stuff going on in America right now.
Yeah, there absolutely is, and there's clients out there that are being affected, but we're trying to help them position to be opportunistic because a lot of people are freaking out and being stagnant and ultimately not making the decisions because they're waiting. And so we're trying to help them understand that there's opportunity here, whether it be take market share or renegotiate contracts in their supply chain. So it's not all negative. It just depends how you look at it.
Well, I think the negative and the positive is just a matter of your perspective and just personal proclivities. One of the reasons Matt and I were really looking forward to this conversation is we are seeing a lot of acquisitions in the SMB space. So we would hope to do a deep dive there on how you're consulting businesses for those acquisitions and how you can get them due diligence ready for either being acquired or acquiring. So let's kind of spill that, pull that yarn.
Lou, I love it. That's a phenomenal question, and it's exactly what we do. We really look at the full life cycle of the SMB owner, and we really help them understand what does an exit look like and how do you prepare to get there. The interesting part is most business owners think their business is valued more than it is. Shocking, right? And then we have to go through and have a tough conversation with them about the true value. And we then try to help them reverse engineer what that success will look like over time to get to the number that they think. So they think their business is worth 12 million. Turns out it's worth 3.5. The place in south of France is no longer being bought. It's getting Airbnb'd. We got an issue here. We got to have a conversation with the family. And so it doesn't mean that it can't get there. We just have to help them actually get there. And so that's a lot of what we'll do in terms of organizing the finances and, bringing together and aligning not just culture, but performance among the department heads of sales and marketing so that we can actually attain that valuation for them.
So, Tom, the one reason we were really, really keen on speaking with you is a lot of CFOs that we meet are, forgive the expression, but really expensive and fancy CPAs. But you've been in the trenches. You've had startups, you've founded companies, you've exited, you've worked for prestigious investment banks, right? So you bring that skill set to the small business space. How has your experience as a founder yourself created maybe a little bit of empathy when dealing with entrepreneurs today?
I love that question. It's given me insight I think most people probably don't have, and not just on a peer set competitive level, but just in general of how to approach and speak with these individuals and understanding the stress that they're under. Everyone always talks about putting payroll on a credit card or whatever. We've come in where clients have had to do that before we were able to help really turn things around for them. And you can feel the tension, across the room, even virtually. And ultimately, it's given us the opportunity to not just empathize with them, but then have a game plan and say, I've been there. I get it. I understand where you're at, but here's where we're going. So we got to stop looking in the past and start talking about the future. And so that kind of is really helpful of being a growth-oriented CFO. A lot of people, I kind of categorize CFOs in two camps. You got your cost cutters, you got your growth mindset people. Maybe it's abundance and scarcity mindsets. And the cost cutters are typically the ones that don't really relate to the founder, because they come in and say, hey, you gotta kill off your baby, or you gotta go ahead and fire your aunt, uncle, and cousin. They look at their team as family, even if they're not.
26,000 at a dinner?
Yep, exactly.
$1 for whoever gets that movie reference.
Gosh, I'm out of luck. What is
Wolf
it?
of Wall Street.
Wolf of Wall Street. Nice. I love it. Yeah, so that pretty much, yeah. I mean, look, we think about things in terms of growth, and ultimately that really relates to them, because it gets them out of the mindset of, we don't just have to cut costs, but we can think about growth and keeping our team intact, not just cutting heads, because that's not fun.
But that requires some hard conversations and some real accountability from the business owner, right? And I think a lot of them, they're just not ready to have it sometimes, right? So they have to find somebody that they trust that's actually going to ask them the hard questions. Why are you going out and using personal credit cards right now? You're damaging your credit score. We're never going to get you out of this into a better financial situation with better lending vehicles if you keep doing this. So we have to put a stop to something somewhere. So I think cutting costs may be part of the solution, but it's not the end all be all.
Really well said, Matt. You can't cost cut your way to profitability forever. And ultimately, you have to think about the growth side. But you're right. You have to be responsible. You have to be accountable. And I think that accountability across the department heads, and if they don't have, when I say department heads, I'm talking, who's ever kind of running marketing, who's running sales, who's running ops, aligning them to understand, what it's going to take, and have the right KPIs, those key performance indicators of, it's the compass. Are we going in the right direction? Are we going in the wrong direction? And so ultimately you're spot on.
So, the M&A space has been a buzzword probably since the SBA loosened everything up somewhere around, I don't know, the end of 2020, 2021. And you have everybody and their brother running into the space. They want to be a searcher. Now every freaking Harvard grad and MBA, they don't want to work for a company anymore. They want to go and operate it. And we were having a conversation off camera before. There's a real big difference between operating a company, being in the trenches, and working in an investment bank in an ivory tower, right? With the new changes coming to the SBA in a couple of weeks from now, it's going to get a lot harder for them to access capital as easy, right? How do you think that's going to change moving forward?
That's really, really interesting. And Lou, going back to your question, I'm remembering now, it was the father in Wolf of Wall Street at the table.
Yeah.
That said that quote.
But it was a good dinner. Tell them about the dinner. Tell them about the dinner. Those oysters.
It was marketing.
Oh, I just got the flash in my head. I go, oh man, we got to turn that on tonight. All right. So great question. Ultimately, you're not wrong that it opens up a door for institutional money to kind of continue to segment their pigeonhole of the traditional private equity market, where you're seeing a lot of them move down market. What I mean by that is you have a lot of middle market players, that are buying up companies. You can define the revenue ranges or the EBITDA ranges. Historically, they're not going to touch these small companies, and now they are. They're looking at them, and they're looking at them as roll-up strategies, and they're taking a lot of the playbook from Shore Capital, the guys here in Chicago that perfected the lower market private equity model, where they would get that $5 million company and grow it to 25, and they would use young, hungry talent to do it. And so, and they're the best in the biz. And now you're seeing a lot more people, which, don't get me wrong, people tried to do that at the institutional level and failed, and have failed miserably. And there'll be people in the future that do fail as well. And so, because it takes a special hungry person that PGs, personal guarantees, that SBA loan that says, we can't let this fail. Whereas institutional money, well, your operator, your CFO, your CEO, they might walk away because there's a bigger, better opportunity and things just aren't going along the thesis that they thought it would. And yeah, that happens all the time. And so I think you
Yeah.
might see more seller financing in order to, maybe bridge that gap. There could be more private investment on the cap table. So there's an opportunity for other people, of individuals like me who historically might have invested in, high flying tech startup, this grandiose big idea to disrupt and change the world, kind of like the foolish mentality I had in my 20s. And then, you start to say, hey, these cash flowing, boring businesses, they look pretty attractive. And so it's a great
Tom,
question. And I would love to get your perspective. You're a little bit involved on the lending side. How do you think things might play out?
Honest,
let me ask your opinion on this scenario, okay?
Yep.
These principals, these owners, these operators, family businesses, it didn't take them a year to create this business. It took decades, maybe 25, 30 years. Is there a conversation perhaps for that entrepreneur seller where maybe the sale takes a couple of years? Maybe he transitions out. Maybe there's a key personnel. Maybe the person coming in doesn't lean on 100% financing and you cash out on day one. Maybe you cash out during the course of time. And maybe that's what the new reality looks like, perhaps.
Yeah. I have friends that have done 100% seller financing deals with owners where they have aligned their interest and they've really believed in the new owner. And they wanted to make sure that the team that they put together in this, beautiful company that they built with the culture stays intact. And so they stick around longer than what traditionally maybe a 6 month or perhaps a year transition might look like historically. And so I think there is opportunities there for sure. I just know that most business owners, when they do go to sell, they don't want the keys back to that car. They're done. And so it does present the opportunity and risk that this individual could end up driving this company into the ground, end up totaling it in some capacity, and then they're left with it back and at a significantly lower value with all the headaches. And so there is risk in that seller financing aspect for sure. And so I think the ability to take some cash off the table, maybe tie in for alignment of making sure the transition is successful, does make a lot of sense. But there's always risks.
I think what you're going to wind up seeing is more partial buy-ins, right? With us, with either earned or a more laddered way to get the owner out of the business with equity rather than just full seller finance, right? I think the rules will be a little bit less stringent there. However, look, again, June 1st is the new rule changes that go in place. Well, let's see what happens. Like anything else, if they think things got too aggressive, they're gonna make it really short, right? They're gonna tighten everything as much as they possibly can, and then eventually things will just start to loosen up again, and we'll see where we really fall, where the cards fall.
Yeah, I think you're right, Matt. That's usually how things go.
Tom, I'm curious to have your insights. When you're dealing with entrepreneurs, whether they're a contractor, a carpenter, an IT technician, what is the most common mistakes, singular or plural, that you see in these businesses when they first hire you?
Not enough focus in on their funnels. So what I mean by that is their traction funnels for marketing. So top of funnel leads that are coming in. That's number one. Where are they coming from? How are we tracking them? And what are we benchmarking them against in terms of saying this is going well and not going well? And then additionally, then sales is the next aspect of that funnel. What's the sales conversion funnel look like? What's the process in terms of breaking that down, and making sure that there's a good process there, that there actually is a sales process, not just here's my proposal and then, oh, we never heard back from them. That's not a good process. And so that's probably number one. Number two, I would say the inability to really right size the business for where they're at today. They might have hired ahead of growth, but things didn't turn out the way they had hoped. But now they have an affinity for, Tim and Sally, and they don't have the ability to let go. And so unfortunately, sometimes, like we were talking about, Matt, you do have to right size the business, and the costs unfortunately do need to get cut. And that's always a tough conversation. And so not doing that quick enough is the second biggest mistake. And then if a company is raising capital, whether that be debt or equity, we usually see that they're not thinking about it in the right way of either how do I service this debt, or how much equity in terms am I giving up to get this money in the door? And what cost is it coming at? There's a low cost of capital and high cost of capital. And there's risks with debt and equity, obviously, but ultimately not understanding what that burn is going to be and how long that cash is going to actually take you is the third most common mistake that we see. Sometimes that's number one. A lot of times in startups too that are raising capital for the first time, they're a little overzealous in their valuations and their ability to execute.
Tom, I know some of us work best with case studies and experience. Can you share a success story where these implementations have dealt with a 5x return, a 10x return?
Yeah,
please.
Sure. I won't give any names, and so I'll try to do my best on paring back what sometimes are slips or F-ups. But you guys got a producer that can edit that out, right?
Yep.
Sure.
Good. So we'll talk about, I guess, maybe this e-commerce client that ultimately was looking to grow their business. And, when I came in, there's really foundationally, there's two aspects to the business in the world that I come from. There's the accounting, and then there's the finance. Accounting is really the rear view mirror. Those are well, let me rephrase that. Bookkeeping is your rear view mirror. Where did we come from? What did we do? Books get closed. We know what we did. We know where we came from, but we're not looking out the windshield, looking at the future for finance, growth. Where are we going? And what do we know about that path ahead of us? Are we driving aimlessly without a map, without that reverse engineered playbook or map? And so what we did for this particular client was they had nothing. They had a bookkeeper that closed the books at year end, and they ultimately just tossed it on their tax accountant's desk, and they just managed their business from effectively, the Shopify dashboard, and said, we're good. Things are going well. Sales are going. But then it was like, why aren't we profitable? We feel like we're losing money. Cash isn't coming in the door. And so ultimately, what you first need to do is lay down that chart of accounts. That's effectively how the accountants really, or the bookkeeper really lays down where everything goes in terms of your P&L and organizing your costs and your revenue accordingly so you can have financial insights and build that strategic roadmap. And so that's really kind of first level. And then additionally, you've got people that are doing the accounts payable, accounts receivable. So those are going to be you maybe one person if you're a small business. They're really running that kind of day-to-day, or maybe they're a part-time person that are running the day-to-day, and they're helping move things along in terms of cash flow. And then you have your fractional CFO who's saying, great, glad now we have a foundation to extract those financial insights and be able to put them into action in terms of growing the business. Now, most e-commerce businesses are undercapitalized, and they don't realize that the break even based on their margins and shipping, especially if they're using these 3PLs and these other platforms, even if they're doing fulfillment themselves, the margins are slim, so they need tons of volume. The problem is you need working capital. That's where factoring comes in sometimes, but it doesn't get you all the way there because you're going to need more and more. And no one really truly realizes the extent of how much, let's call it critical mass, to cover overhead is. What I mean by that is you have a team of marketing people, operations, fulfillment, maybe your bookkeeper, those accountants we talked about, and then maybe a fractional CFO. And you then have to cover those costs. The amount of capital required to actually break even on that overhead could be close to $1 million if you're really doing it right. And the companies that are in these early stages and growing, and they're just breaking even, or they're losing some money, or they're really operating on a shoestring budget where they don't have the team and they're going to get burnout if they don't get here quickly because they're doing everything and wearing every hat. That's tough. And so making sure that you have, if companies are going to raise capital for that and solve for that, debt or equity, you really want to make sure you understand your cash burn and how far, let's say, that gas in the car is going to take you, because you might run out before you hit the next gas station. And that is a huge problem, because you're either going to be personally guaranteeing the debt, or you're going to go back and you're going to offer a pound of flesh for equity. And that means you're going to be diluting your value that you own in the company. Ownership, not, it's ultimately in value, but yeah, not to get nerdy there.
Yeah, the cash flow cycles for those companies are I'm sorry, the cash flow cycles for those companies, there's definitely injections of capital that's needed. There's been a lot of lenders that have popped up over the last 3 to 4 years, especially for the eComm space, right? Because it's easier for the lenders to do their underwriting, and they're not taking equity. It's all debt or receivable purchases from what they're doing in the SaaS space, because once they can plug into their back end, they can actually do their underwriting relatively quickly. You have companies like Clear Capital. Lou, what's the other name? What's the name of the other company that we use?
On-Ramp, we love them.
On-Ramp all the time, because most of the big spend on the eComm companies comes because they got to, usually, if they're buying from China, they got to buy everything 3 months before, right? In order to sell it, because by the time it gets here on the ship and offload it, right now, I mean, in June, we'll have people coming to us so they can stock up on inventory to sell in November and December, their biggest time of the year, right? So it's eComm companies in general, I think, definitely, like you said, need more capital than they think they do when they first start out.
Matt, Tom did such a good job in not disclosing any details about that company. Do you think maybe he could share another story on the opposite side of the spectrum? Because I got to tell you, CFOs are not for everyone. Some people are just stubborn. They're altacakas. They just won't listen to anybody else. Can you tell us a story, Tom, on an instance where you had to fire someone who just wouldn't listen to your advice and just wasn't a good fit? Because the CFO track is just not for every small business owner.
Yeah, Lou, you're not wrong. And there are some times where you go in, especially early on in your career.
And please give like really
Detailed specifics,
sexy details, because our producer will don't worry, we will not edit it out. Just give us sexy details.
So look, ultimately there are situations, especially early on in your kind of career. For me, I started taking on clients, just me, independent. I didn't think about it as growing it as a transferable asset that I could sell one day. I didn't grow it in terms of having a team. I grew it and said, wow, look at the cash flow coming in. This is fantastic. I didn't think about it in the context of how can I support myself around burnout and build a real organization to support more clients so that we can add value to this community. And so early on, you're really just jumping at the opportunities that come, and you're taking on clients that probably aren't a good fit. We've done a much better job identifying those people now. Of it's not just ability to pay, it's ability to have an open mind. And that is probably the hardest factor to decide, because when you're meeting someone, they're telling you that they need all these this help and they want these changes and they're willing to do it. But then when it comes really down to the brass tacks, they aren't willing to do it, and they won't do it. And then they're like, what do you mean? That's what I'm paying you for. And like, like, hey, we could run your this company maybe a little bit better and you want us to go and basically tell your people that they're getting laid off, but that's not our role. That's not our job. We'll identify where there's opportunities and what you need to do to right size and where you need to go and put that playbook together. But you got to think about it in this context. If you're a CFO full time, how much value can you create for this organization? And then in a fractional capacity, how much value can you create for this organization? It's the same amount if you have someone with experience. It just might be a little bit of a longer duration in which you can implement and do so. And so you lean on that core team to help do those aspects of the job that, you're not going to be sitting there and letting go the team you just met. I mean, that's just kind of weird. And so you're hoping that they have people in place that understand that we are a leadership management team and here are our roles and responsibilities. We are a resource to you, and to get the most juice out of this, lemon and squeezing us is to leverage our resource the best possible way that you can, which is ultimately telling us, strategically where are the biggest problems, and then tactically how do we solve them. We're not going to be able, with the time we have for how much you're paying us, which is not a lot, to actually go and execute every single thing. So this particular story, this individual wanted us to solve for their business development issue, but they didn't want to fire the person who was in head of business development. Well,
Was it his son?
It was not. That's a really good question. That's a whole nother story on a marketing person that was
Those family businesses
marketing for their own account, but not the business account. That's another story. But ultimately, it was just it's an unfortunate situation, and I felt terrible for him because there was this affinity, and you're coming in not callous. Like I'm a founder myself. I've fired myself first financially from a company, and still had to operate it. And then, letting go people is the worst thing ever. But do you want to let the ship sink with everyone on it? Or do you want to put a couple people on a life raft and let them go and help them find a new job so that everyone can survive? I'll tell you, 10 out of 10 times, the latter is the best route. And so in this particular case, it was just, I don't know if it was an ego thing or some sort of inability to let go. I don't know. I wasn't around long enough to really diagnose like the psychological constraints I was up against. But ultimately, it led to the fact that we didn't have sales. The business development person needed to be replaced, but they wouldn't. And they came at a high salary. And that ultimately led to trying to spend money in other areas of marketing that all fell short. And there was always this new agency that had a problem, had the solution to our problem. Okay, maybe, but this business really screams we need business development because it's relationship based, kind of like mine is. I can't just go spend a ton of ad money on Google and expect to earn trust. That takes time and conversation. An ad is not going to do that from a static, even mobile ad. Or video. It's just not going to. And so that was a really tough one. And that was early on where I don't think I had the tools to really have the conversation, where I probably needed to pull in data and say, if we said, here's all the people that were valuable to the organization and what we need as an organization, and found a way to rank order them and said, if they're above 17, they stay. If they're below 17, they've got to go. Not in a callous way, but somehow the conversation wasn't working. So maybe a visual on the data would have worked, whereas something that we've successfully implemented after that. But I kind of wish I had that framework to go off of back then, because it might have worked and it might have saved the organization. But unfortunately, you can only bring the horse to water.
Dr. Dillon, this is the part of the podcast where we ask the doctor to now lay down on the sofa and we do a little psychoanalysis on you.
Great.
As a CFO business, how does one scale a CFO business? Do you add on more CPAs or more CFOs in your line? Do you bring in MBAs? Do you outsource it with 1099s? How does one scale a CFO business? Because like you said, it's relationship driven, but there's a niche, very dynamic skill set that you need to seek.
Yeah, it's a great question. So let's define scale. Some people think it's growth, and it's not. Scale is really for you get more value for the same number of dollars put into the organization. So let's call value profit. If I put in $1, I get 4 back. If I put in 1, I get 8 back. Now all of a sudden we're basically getting scale on our resources and our costs. So looking at it through that lens, ultimately, you really have to think about the quality of your service providers and the organization that you're creating from a cultural and expectation standpoint. Where are you going to be involved? Where are you not going to be involved? Are you lead gen and you're building your organization with people that are supporting you as the CFO, or are you looking to be the CEO of a CFO, fractional CFO firm? And so for us, we're looking to be the CEO of a fractional CFO firm. And that means in order to scale, we need to build an incredible platform that allows and supports our team members and helps them develop and tap into the various skill sets of our team. There might be an expert in M&A, there might be an expert in lending, there might be an expert who does, interesting aspects in one particular industry, that we can leverage into another that we didn't realize. And so there's these aspects of kind of building that foundational part of the business that supports them, not just operationally, so that they can just focus on the client service, but then also resources to really help add the most value to the clients, because they're not just hiring us or they're not just hiring that fractional CFO, they're really hiring us. And so it took a while to kind of change that triangle sale to let me tell you my story and earn trust with you, to let me earn trust with you, sell you on Frac Finance, as well as have you sell you on the fractional CFO. And so it changed the whole dynamic in how you approach the business. But ultimately, it really dives down in how you scale. To answer your question directly, Lou, is can you attract the talent? Can you bring someone on who trusts you, that you're going to be supporting them and that you're going to be bringing good clients to them, so that they can have, faith that you're going to continue to be paid. And so for us, we're really about bringing the best of the best into our organization. And so for us, we just brought on a fractional CFO from the private equity world who was CEO and CFO of multiple portfolio companies in that lower market, the SMB perfect market, the perfect CFO who has scaled companies from 5 to 25 million. And so they wanted to downshift from that private equity world of we have a 5-year time period to return money to our LPs, and then we continue to move on. That's a really, really hard world to live in if you're starting and raising a family. And so for us, we have an opportunity to connect with those individuals that are looking to downshift, but they have all the value to provide the client, but they don't want to spend that same amount of time and miss those bedtimes of what it takes to really work for institutional capital. And so that's where we really view the opportunity to scale, is attracting and helping support that talent pool. And if we can get the client on the business development front, the lead flow, and our sales conversion, now we are scaling.
So your selling proposition there is a better quality of life from the institutional world.
Yeah, effectively. And it's the support people that are, kind of, if you look at it in terms of like today versus the future of where our firm would be going, we probably have more support staff under each one of our, let's call them, rainmakers, if you will. Look at a traditional consulting firm like a McKinsey. That's effectively what the business model to scale would look like.
So Tom, why don't you tell everybody where they can find you and get in touch with you over at Frac?
LinkedIn, Tom Dillon, CFA on LinkedIn is probably the best way. And then additionally, you can always reach me at my email, which is tom@frakfinance.com.
Tom, thanks so much for being here. I do have one question before we let you run. We always see people with a dream of wanting to sell their business, right? But you don't just wake up one morning and say, hey, I'm going to sell this and I'm going to drop a for sale sign in front of the business, right? It usually takes 6, 12, 18 months probably on average to sell that business. How do you stop your clients from when they think they have an offer on the table and people are going through due diligence to not pull back in the business, but more importantly, double down, because these sales usually fall through and they're already thinking the money's in the bank when it's not there, right? Something always comes up, whether it's an institutional buyer or another buyer, they're always going to look at the earnings of the company, right? They're always going to try to give you that haircut at the last second. And I feel like what I see mostly is a lot of buyers check out halfway through the process. And they're like, just give me what I can get. A lot of sellers, excuse me.
We have seen that. I love that you brought that up. We have a business closing today that was out in. This will be posted at a later point in time, I believe. So I'm okay to say it. So in Asheville, North Carolina, and what happened was there was floods that obviously just wreaked havoc in that community, and ultimately that crushed sales, halted the business to zero. I mean, this was like, we're going to sell a company, I'm going to be a millionaire, and now all of a sudden we're zero. And so that was an extreme example. But you're right, we had to really bridge the gap between those buyers and what the seller expectation was, and know that this is a catastrophic event that's a one time. And then how do you have that conversation and manage the egos to say, look, this isn't an opportunistic time period for you to just take this business at a low value and then reap the benefits of all the development in the future. So we said to the seller, to your exact point, double down on what you're good at. Start selling again. Support the community. Let's get and build back. And they're going to see the growth, and then they're going to want to get on it before it's too late. And so you're 100% right. It's usually, a lot of times these businesses get valued on trailing 12 months performance. So now's the time. Let's keep growing, not stop. It's a really good point, Matt.
I think it's important, right? Because like you said, trailing 12, but if it takes 12 months to sell the business, you have an offer, let's say due diligence takes 6, what happens in the next 6 months? Why did your sales go down? Why is the profit down? Why is the revenue down? Well, because, I was dreaming about going to Hawaii and bringing my wife on the beach. But you could pick it right back up. That's not going to fly, right? I think people really need to realize that, you really have to, like when I used to fight in martial arts, the rounds were 3 minutes, right? 2.5 minutes, you're done. You got to go the hardest you possibly can in that last 30 seconds. And I think it's important that business owners know that when they're selling their business, not just the offers on the table, most of them die. Then you got to pick it up again, but you have to have the endurance to follow through and push harder than even when you first started.
Great point. I love that. It's a great analogy.
So, Tom, thank you so much. Everybody, that's a wrap of the Liquid Lunch Project. We'll see you in the next episode.
Let's go!